St. Louis Fed President Jim Bullard is the interview I'm talking about. He said he supports raising interest rates by a full percentage point between now and the start of July. By July 1st, he would like to see 100 basis points in the bag. That's the direct quote. He said, "I was already more hawkish, but I've pulled up dramatically what I think the committee should do." And a lot of the other quotes were, I think, even more striking. Let's dig deeper into the inflation data right now with Yelena Shulyatyeva, senior U.S. economist for Bloomberg Economics. Yelena, what struck me was that Bullard said, you know, there was a time when we would have moved now on this and done something immediately. Was that a little bit of a slight that the Federal Reserve isn't moving quickly enough?
Well, look, they also still adding accommodation through the balance sheet. So it would be really interesting to see how they hike rates and continue to buy assets. So I guess they will just move more aggressively in March, and that's what the latest data are telling us. They may seriously consider a 50 basis point hike in March, and they will perhaps move at each and every meeting after that. So today's CPI report pushed the probability of a 50 basis point hike already after the release, and the latest comments from the Fed official are telling us that they are seriously considering that. So the Fed has about 2 weeks till the blackout period starts before the March meeting. So I think we will hear much more from the Fed officials in the next couple of weeks, just to see how they're reacting to the latest CPI data, which was quite surprising to the upside, and it was broad-based and in certain categories that are, very important for the U.S. consumer.
The Fed just did a 180 with rate hikes. FOMC minutes revealed. The minutes came out this week, and boy, do I feel a case of deja vu again. Credible threats. It really is starting to get old. So they are stating, based on the minutes, that they are ready to start raising rates soon to shrink the balance sheet. Okay, they said that in November 2021. It's February 2022. Let's look at an article from CNBC. 3 key points. I'll put it in the description below, and it's going to be up top up here. First, Federal Reserve officials outline plans for interest rates hikes, and reduction in the asset holdings on their balance sheet at their last meeting in January 2nd. The minutes released last week, Wednesday, from January session shows concern about inflation and financial stability, though members urged a measured approach to tightening monetary policy. And third, FOMC members noted that inflation was beginning to spread beyond pandemic-affected sectors and into the broader economy. What? Let's take a look at this. Roll clip. Fair use.
Futures markets priced pretty firmly in a 50 basis point rate hike in March. Was that a correct interpretation of what you were saying?
Yeah, Steve, as you know, we got the hot CPI report last Thursday, I guess, and I think, my interpretation was not so much that report alone, but the last 4 reports taken in tandem have indicated that inflation is broadening and possibly accelerating in the U.S. economy. So I shaded up my position, and I'm just one person on the committee, but I shaded up my position to say I'd like to see 100 basis points worth of movement on the policy rate by July 1. So I also said I would defer to the chair exactly how to go about that, and he's very good at managing the committee and everything else that goes with this. But I do think we need to front load more of our planned removal of accommodation than we would have previously. We've been surprised to the upside on inflation. This is a lot of inflation in the U.S. economy, 7.5% on the headline CPI. These are numbers that Alan Greenspan never saw. They haven't occurred in 40 years. So our credibility is on the line here. and we do have to react to data. However, I think we can do it in a way that's organized and not disruptive to markets. We're only removing accommodation, so it's still an accommodative policy as we go through these initial rate hikes. They're rather cheap, actually, given that unemployment's down at 4% and the economy is expected to grow, let's say, 3.5% to 4% this year. So I think my position is a good one, and I'll try to convince my colleagues that it's a good one.
Some said the January inflation report was really not much worse than expected. Actually, just a couple tenths higher.
No. Let me push back. I'm pushing back on that. This is. I said, let's take the four reports together.
Go for it.
Let's take the four reports together since October, because it's really October, November, December, January that has really called into question any idea that this inflation was naturally going to moderate in any reasonable time frame without the Fed taking at least some action. So it's that, I think, sure, any particular report is, a few tenths here, a few tenths there, but the big picture is that inflation is much higher than we would have expected, let's say 6 months ago or 9 months ago, and certainly 12 months ago. And so we've been surprised to the upside. And if you look at the Atlanta Fed's inflation tracker, it's all turned red. So it doesn't really matter how you measure inflation. All the different measures are way above their norms.
It's down 340, 350 at the low of the session. It is now flat. And Mike, I guess shrugging off some bad earnings as well overnight, certainly some bad reactions to earnings, and strong data that could have pushed yields quite a lot higher.
Yeah, yields sitting it out. So it seems like people feel like we've priced in what's likely to happen Fed-wise at this point, even perhaps with inflation, leading indicators of that peaking out. And then, if you take out the idea that it's very evident that we're still in selling rallies mode in the big, expensive stocks and some of the pandemic favorites. Outside of that, again, I keep pointing to the equal weighted S&P. It's almost, like 4% below its high. It's outperforming this week, this month. So it seems like there's a little bits of traction, even though overall market still has plenty to prove. We're still, about halfway, or not quite, between the lows and the highs of January. Non-committal at this point.
And for the first time, we really got a reaction from Fed minutes or from anything Fed-related that was not considered more hawkish than the market thought, because the market has gone a long way to pricing in 6 interest rate hikes this year, half of 50 basis point hike in March. Market getting ahead of itself, maybe?
Or at least fully priced for it. I mean, it's interesting because, you took 3-week-old minutes from the Fed meeting where it didn't show a huge sense of urgency. I think the market wanted to make sure that Bullard talking half a point and getting to 1% of hikes by July 1st was not somehow conveying the middle of the committee's thinking back in January.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the minutes from the recent FOMC meetings. Losing control here. So it looks like they keep saying that they will raise rates, but it looks like a boy crying wolf type scenario. This is why I hedge, save, invest, plan, and always act accordingly. Guys, watch what they do and apply your plans. Execute to win. Apparently they are. They keep us in the loop, showing us one hand while the other hand is in our pockets. Let us continue to use our freedom to excel and prevail, because I know when I change, things change. Next meetings are coming in March. I'll continue to bring the news. Guys, thank you for sticking with me to the end. Stay free.
It ain't hard to tell. I excel, then prevail.